In this video, I am going to be explaining how you can minimize your capital gains tax that you pay on any investment properties that you have in Australia. So first of all, we're going to be talking about what capital gains is. Second, we'll be talking about how it's calculated and how much tax you have to pay on it. And third, make sure you stay around for tip 3 because I'm going to be sharing a couple of strategies that you can implement to minimize or maybe even completely eliminate your capital gains tax on your investment property. Stay tuned. Hey guys, my name is Michael and I'm an accountant from Australia. On this channel, we talk about money and finances so we can all live more fulfilled lives together. Now in this video, as I mentioned, we are going to be discussing capital gains tax and how you can eliminate it on your investment properties, specifically in Australia. So first of all, we need to discuss what is capital gains tax. Capital gains tax is simply a tax that you have to pay on the profits that you make on any capital assets. Capital assets are things like investment properties, stocks, cryptocurrencies, antiques, jewelry, just to name a few. And the tax that you pay is based on the profit that you make. So very simply put, the capital gain that you make is the proceeds that you receive on the sale minus the cost base that you paid for when you bought the asset. So that's your capital gain profit. But what actually is your capital gains tax? Now, this capital gain profit that you made, which was the sale proceed minus the cost base price, will simply be added to your taxable income. This means that say if you make $50,000 from your salary and you also make a $50,000 capital gain, that your total $100,000 profit for that year will be taxed at whatever the marginal tax bracket is. So here in Australia, there's no set percentage of tax that you have to pay on a capital gain. It just relates to what your tax bracket is, keeping in mind that any capital gain may push you into the next tax bracket. So keeping this in mind that your capital gain is actually related to your taxable income, we can discuss some strategies that will minimize or maybe even completely eliminate any capital gains tax that you have when you sell your investment property here in Australia. The first strategy I want to share with you is that you should consider the timing of when you sell your investment property. So let's just say that you know for sure you're going to get a pay rise next financial year, and so your income at your job is going to be a lot higher. Well, in that instance, you should definitely consider selling your investment property this financial year while your job income is maybe a little bit smaller than what it would be next year. This means that any capital gain that you make will be added on top of your smaller job income this year compared to your bigger job income next year. Therefore, you'd be saving a little bit on taxes. The second strategy that I have for you is also to do with timing, but it's to do with how long you hold the property for. Here in Australia, if you hold a capital asset for longer than 12 months, you get a 50% gain discount. So let's say you buy your property for $50,000 and you sell it for $100,000 in 2 years' time. That's a $50,000 gain, but since you've held on for it for longer than 12 months, you get a 50% discount, bringing your gain down to $25,000. So if you've only held onto your property for 8, 9, 10, 11 months, just hold off a little bit. Wait until the 12-month gap so that you are eligible for that 50% discount, which can be a massive saving. The third strategy I have for you is to do with the primary residence exemption. So here in Australia, there actually is a capital gains exemption on your primary place of residence. So if you're selling your family home, you don't have to pay a capital gain on that. It's only on investment properties. Now, it's important to note here in Australia, you may only have one primary residence at a time. You're not allowed to claim your normal family home and a beach holiday house, both as your primary residences, even if you split your time. So it's wise to choose which one is your primary residence, possibly one that's going to have a bigger capital gain. While this might not be relevant to you right now, since this video is explaining rental properties, this brings us onto our fourth strategy, which is the temporary absence rule, also commonly referred to as the 6-year rule. This rule looks like this. If a place was originally your primary residence or your family home, and you have since moved out and maybe rented it out to get an income, you may, for 6 years, call that place your primary residence if you haven't called another place your primary residence. So if you bought a home, lived in it, and then decided you're going to move out and maybe just rent a place somewhere or move back in with your parents, or you go overseas, when you come back to Australia, you can call that place your primary residence for up to 6 years of the date that it's rented out. Which means when you go to sell it within the 6-year time frame, it's your primary residence, and you're eligible for the primary residence exemption, completely wiping your capital gain. Another huge thing with this rule is that if you move into it at any time, the 6-year rule resets and you get another 6 years. So if you live overseas, just come back, live in it for 6 to 12 months, and then you get another 6 years of it, calling it your primary residence. Now, our fifth strategy has to do with increasing the cost base as much as possible. And lots of people don't know how much actually can be claimed in the cost base. So the ATO provides guidance around this. First of all, we have the acquisition price, which is the price of the house that you paid for it. Next, we also have incidental costs. So that's things like stamp duty, agent's fees, any other professional advice that you gained, advertising, valuation costs. There's a whole bunch of incidental costs to do with the buying and even the selling of the house. Next on the list, we also have costs of ownership. These are non-deductible expenses that you incurred, usually interest, rates, land tax, repairs and maintenance. Usually those four. And last, to do with the cost base, we have any significant capital improvements to the property. So that's construction, renovations and extensions. And our last but not least strategy is all to do with utilizing other capital losses that you may have. So this could either be capital losses that you've had in previous years, which will then offset your capital gain this year, or this could also look like realizing some other capital losses this year. So for example, if you're holding onto a couple of shares that are in a massive loss and you want to get rid of them anyway, it may be a good timing to do it in the year that you plan on selling your property, so that you can offset your capital gain from the property with the capital losses from the shares. And so in summary, in this video, we just talked about what the capital gains tax is, how it's calculated, and I just gave you a couple of strategies to help out. So if you found this video anyway helpful, please leave a comment below. I get back to all of the comments. Give it a thumbs up and please consider subscribing for more future content to do with investment properties and Australian finances.